Business Finance Unit 5. Analysis of Accounts 5.1 Profitability Ratios 5.1.1 Gross Profit Margin 5.1.2 Net Profit Margin 5.1.3 Return on Capital Employed 5.2 Liquidity Ratios 5.2.1 Current Ratio 5.2.2 Acid Test Ratio 5.3 Users of Published Accounts 5.4 Limitations of Ratio Analysis. Analysis of accounts. Analysis of accounts means using figures from the financial accounts to make useful observations about the financial performance of a business. Analysis of accounts mean comparing performance with previous years or comparing performance with competitors. Profitability. Profitability is a business's ability to produce a return on an investment based on its resources. It shows how successful a business is at converting its sales into profit. Profitability ratio is classified into gross profit margin, net profit margin, return on capital employed. Gross profit margin. Gross profit margin is the percentage of gross profit to sales revenue. Gross profit margin shows how efficiently the business is converting its cost of goods sold into profits from the sales revenue made. When gross profit margin increases, it is a good indication that the selling price of the products is higher than the cost of the products produced. This can be probably because advertising has persuaded customers about the quality of the product or materials has been purchased from cheaper suppliers. When gross profit margin decreases, it is a bad indication that selling price of the products is lower than the costs incurred in producing the goods. This can be probably because management has failed to control costs of production and operations due to wastage of resources and materials. Net profit margin. Net profit margin is the percentage of net profit to sales revenue. Net profit margin shows how efficiently the business is converting its total expenses into profits from the sales revenue made. A rise in net profit margin is a good indication that total expenses are being covered by the sales made. This means the business is efficiently controlling its costs and expenses in order to make sales revenue. A fall in net profit margin is a bad indication that sales revenue is not enough to cover the total cost expenses of the business. This means the business is unable to control its costs. Return on capital employed. Capital employed is the value of all assets used by a business in operating its business activities. Return on capital employed is the profit made from all the assets used by the business. Assets used by a business includes the total of all its fixed assets and current assets minus its current liabilities. Capital employed is also the sum total of shareholders' equity and non-current liabilities. A high ROCE is a good indication that the business is generating high net profit from all its assets capital invested by shareholders. A low ROCE is a bad indication that the business is not generating enough net profit from all its assets capital invested by shareholders. Liquidity. Liquidity is the ability of a business to pay back its short-term debts by easily converting its current assets into cash in order to pay its current liabilities. Illiquid means that assets are not easily convertible into cash. For example, the most illiquid asset is closing inventory. Liquidity of a business can be analyzed using current ratio equals current assets divided by current liabilities. Acid test ratio equals current assets minus closing inventory divided by current liabilities. Current ratio. Current ratio measures a company's ability to pay short-term obligations. A current ratio of 1.52 is a desirable value. If current ratio is less than 1, it means that the business has less current assets than current liabilities. It means that the business has more debts and it can face a bankruptcy. If current ratio is more than 2, it means that the business is having too much tied up cash in inventory or too much trade receivables. So, there is the risk of having bad debts. Acid test ratio. Acid test ratio is a more precise measure of a company's ability to pay short-term obligations because it excludes inventory. An acid test ratio of 1 is a desirable value. If acid test ratio is less than 1, it means the business is not able to pay off its short-term debts from its available current assets. If acid test is more than 1, it means that the business is safe and can meet its short-term obligations. Users of published accounts. Banks will use financial accounts to analyze the financial performance of the business by calculating its profitability ratios and liquidity ratios before granting loan. Ratios will help the bank to identify the creditworthiness of the business. Shareholders and investors will use financial accounts to decide if they can invest in the business or if they should sell off their shares. They will use ratios to analyze the financial performance of the business. The most important ratio to shareholders is the return on capital employed. Managers will use financial accounts and ratio analysis to compare business performance with previous years or with competitors' performance. Ratios will help managers to decide if they should control costs, invest in marketing and advertising in order to increase sales, or if they should change suppliers of materials. Creditors and lenders will use financial accounts and ratios to assess the business gearing and risk level. That is, ratios will help creditors and lenders to decide if they can extend their credit facility or if they should claim for early repayment. Limitations of ratio analysis. Ratio analysis is based on past historical information, and so the past does not predict future performance of the business. Ratios are calculated using information from the income statement and balance sheet. However, ratios can give misleading values if the financial account is prepared with manipulation. Ratios will not give useful comparison of performance if the business has incurred changes from its previous financial year. Also, ratios will not give useful comparison of performance if the competitor's size, type or activity is different. Ratio analysis cannot be made if information about competitors is not available or valid.